Today, we're going to try and get inside the head of one of the most successful investors in history. We're decoding the business mind of Warren Buffett. It really is a fascinating question. We live in a world that is just obsessed with hype, with the next big thing, with crypto, with high-speed trading. So how did this quiet, incredibly patient guy from Omaha, Nebraska, build one of the biggest fortunes in history? That's what we're going to break down.
To really get a handle on the Oracle of Omaha, you have to go right back to the beginning. His entire philosophy, everything he does, was shaped long before he ever earned that famous title.
I mean, from a super young age, Buffett wasn't just playing around. He was already in business. Selling gum and collecting Coke bottles wasn't just some hobby, it was his first lesson in profit margins and what customers want. He bought his first stock when he was just 11 years old. But the real, absolute game changer came when he went to Columbia and studied under the legendary investor Benjamin Graham. Now, Graham didn't just teach Buffett a few tips and tricks. No, he gave him a single, incredibly powerful lens to look at the entire market through. And this one principle became the bedrock of his entire life's work. And that one big idea? It's called intrinsic value. Okay, think of it like this. Say you're buying a house. The market price might be bouncing all over the place based on what the neighborhood's doing. But the intrinsic value? That comes from the quality of the house itself, how many rooms it has, the land it's on. Buffett learned to focus on the house, not on the noisy neighborhood. And this right here is the absolute key. The market price is what you pay, and it's driven by emotion, fear one day, greed the next. Intrinsic value is what you get. It's rational, it's based on what the business is actually worth. Buffett's genius is basically built on taking advantage of the gap between those two things. Okay, so once he had this core principle from Graham, Buffett built his own system around it. You can think of it as a blueprint, really, with 4 simple but powerful pillars for finding great businesses. So the very first pillar is his search for what he famously calls an economic moat. And yeah, it's exactly what it sounds like. Think of a medieval castle. The wider and deeper the moat, the harder it is for anyone to attack. For a business, that moat is its competitive advantage. So what makes for a really wide, deep moat? Well, it's a few key things. It could be massive brand power, like what Coca-Cola has. It could be super consistent earnings, year after year. Or maybe it's some unique advantage that competitors just can't copy. The point is, it has to be durable. All right, pillar number 2, and this one is so important, simplicity. For decades, Buffett was famous for avoiding tech stocks. And why? It wasn't because he thought they were bad companies. It was because he felt he couldn't understand them well enough to say with confidence what they'd look like in 20 years. If he can't explain it, he won't buy it. His huge investment in Apple is the perfect example of this. People were shocked. They thought, wait, Buffett's breaking his own rule about tech? But here's the thing. Buffett wasn't buying a tech company. He was buying a consumer products company that has one of the strongest, most loyal brands in the entire world. That was a moat he could see and understand perfectly. Pillar 3 is patience. And honestly, this might be the hardest one for most of us to master. When the market is crashing and everyone else is panicking and selling, Buffett gets excited. For him, a crisis isn't a threat. It's a sale. It's a chance to buy wonderful companies at a discount. He's a master of controlling his emotions. And that emotional control leads right into the 4th and final pillar, discipline. It's all summed up in his 2 legendary rules. Rule number 1, never lose money. And rule number 2, never forget rule number 1. Now, that doesn't mean a stock will never go down. It means having the discipline to avoid permanently losing your money by overpaying for a business in the first place. Okay, so that's all the theory, but where's the proof? Does this stuff actually work in the real world? Well, the proof is a company called Berkshire Hathaway, the incredible vehicle he used to turn these ideas into one of the biggest companies on the planet. It's such a wild story. Back in the 60s, he took control of this failing textile company. But instead of trying to save a dying business, he used its cash to start buying other much better businesses. Berkshire Hathaway basically became his canvas. And if you peek under the hood at Berkshire's big investments today, you can see his philosophy everywhere. Apple's moat, that incredible brand loyalty. Coca-Cola, a masterclass in patience, holding for the long term. GICO, a classic value investment with its low-cost advantage. And BNSF Railway, that's a durable asset that's almost impossible to compete with. But there's one more element here,
a kind of secret sauce that takes all these pillars and just supercharges them exponentially over time. And that is the absolute magic of compounding.
Just look at this chart. It is staggering. The vast, vast majority of Warren Buffett's wealth wasn't made when he was in his 30s or 40s. It was generated after he turned 50. That's what happens when you get small, steady returns and just let them reinvest for decades. The snowball just keeps getting bigger and bigger and bigger.
So at the end of the day, his greatest asset wasn't about being the smartest guy in the room or timing the market perfectly. It was about time in the market, letting his carefully chosen businesses do the heavy lifting for him year after year.
So, when you strip everything else away, what is the one big lesson we can take from the business mind of Warren Buffett?
It's really this powerful cocktail of ideas. It's about finding value in a great business, making sure it has a protective moat, having the patience and the discipline to hold on, letting compounding work its magic, and maybe most importantly, keeping your emotions out of the decision.
I mean, nothing really sums up his entire worldview better than this one simple quote. It's not about quick wins, it's not about chasing hype, it's about becoming a part owner in a wonderful business and planning to stay for the long haul.
And that leaves us with a really big question, right? In today's world of rapid-fire tech and constant disruption, does this slow, steady, patient strategy still win the race? Or is it maybe a relic of a different time? It's definitely something worth thinking about.